Welcome to Finance 397, Personal Finance. This is the Module 4 SLP for Finance 397, which covers financial portfolio, insurance plan, and investment plan. So your financial portfolio, your insurance plan, and your investment plan. So the SLP4 assignment is to develop your own insurance and investment plans in a 3-section report, which covers your current situation, insurance, and investing, which should be 3 to 4 pages, a 3 to 4 page discussion. Include a title page, describe your current situation in life, and then develop and describe your own plan for insurance, and finally develop and describe your plan for initial investing. As per sections 1, 2, and 3 outlined on the next slide. It's highly recommended that you consult an insurance agent and an investment advisor in preparation for this assignment. Neither an insurance agent nor an investment advisor should charge you any money for an initial consultation. Yeah, you can read up on Vanguard and on Progressive or Geico's website, or you can talk to somebody, a salesperson. They're always happy to talk to you for free. So for part 1 of this paper, describe your personal and family situation, family status, are you married, divorced, how many kids do you have, do you live with your parents, etc. Your housing situation, do you own your own home, or you're renting, or you're living with somebody, roommates or whatever. Your job status, including if your employer provides you with any insurance or any retirement benefits. And so, like let's say you've got a retirement plan at work and you have $1 million in it. Do you need $1 million worth of life insurance? Well, if you're single, and you don't have any kids, I don't think you do. I think you just need enough life insurance to cover funeral costs, which is maybe 20 to 50,000, 10,000, depending on how big of a funeral you want to have and how much the burial plot or cremation is going to cost, how much the casket's going to cost, right? So, if you're single, you don't need a lot. If you have kids, yeah, I mean, you're married with children, sure, even if you've got $1 million in assets, you might want to have another $1 million or $2 million of insurance in case you're not around. I personally only have, I don't know, a few $100,000 of life insurance, something like that, not much. And it's term life that I buy through my work, FEGLI, the FEGLI policy I have, Federal Employee Group Life Insurance. As you get older, I'm in my 40s, so the premiums keep going up as you get older. So at some point, I'm going to have to terminate that policy because it's too expensive. If I had bought a whole life policy from a private insurance company, that would have helped me reduce the cost. But I'm married, I don't have any children, so the the I don't know that I need a lot of life insurance anyway, so I'll put it that way. But everybody's in a different situation. Remembering that insurance is for the protection of your financial health, describe the perils that you face, right? So the perils, you have something happen to you, your spouse doesn't work or doesn't make a lot of money, then you're going to need enough insurance to replace your income so that this surviving spouse can raise the children and pay for college. Um, if you don't have a lot of people to support, then you don't need as much insurance. You want to describe an insurance package that insures your financial health, considering your exposure. Another thing is, how much stuff do you have? Some people have a lot of money and it's all in stocks, and they live in a 2-bedroom condo in New York City, and they drive a Toyota Camry, right? So they don't really need a lot of insurance, even though they have a lot of money. Some people have a lot of money and they live in a 7-bedroom house in Saddle River, New Jersey that costs $10 million, and it's full of Louis the Caton furniture and Chippendale cabinets that cost $300,000 to $400,000 each. That person's insurance premium is probably larger than my salary because they need to insure $5 million worth of furniture in a $10 million house. So it just depends on how much stuff you have, how much of it requires insurance. My furniture personally isn't really worth anything. It's a lot of chipboard stuff. I don't really carry a lot of I carry the lowest possible $5,000 or $10,000 of insurance on my home furnishings because I don't think it's really worth anything. I don't really have a lot of expensive furniture. So it just depends on what kind of stuff you like, whether you're somebody that collects things or, likes to have a lot of nice furniture. Um, so, what are your risks that you need to insure? That's the question. All right, so the final part of this is your investment strategy. So now develop and describe investing strategies, including your investment strategy before you took this course, if you had any, a beginning investing strategies discussed in this module, and then discuss three investing for retirement opportunities that interest you. So yeah, investing strategies, right? You know, so if you have a 401k, you can pick various items, various things to invest in. I have a 401k program from a old corporate employer, and I have the whole thing invested in the MSCI Developed World Markets Index. So it's in an index mutual fund. It's an index stock fund. Not much money in it. Uh, my primary job, I have the whole account in the TSPS fund. So I'm a thrift. Many of you, if you're military or government at Trident here, are in the thrift savings plan. So S fund is small cap stocks. The C fund is large cap U.S. stocks. I fund is the developed market index of kind of like the developed market index of like South Korea, Japan, Europe, that kind of thing, developed world stocks. So I have my entire TSP in the S fund. Now, a financial planner would tell you that's a bad idea, and they're probably right. But you should have it in a mix of stocks and bonds. You should have it in maybe like a life cycle fund. If you really, because what happens is if you're in the S fund like me, and in 1929, the stock market crashed 90%. Between 1929 and I think like 1936, 1938, the market was down something like 90%. And that was the S&P. That was like the large cap stocks. The small cap stocks were down 95%. So I could lose 95% of my money. But if things work out, I'm going to because I'm taking more risk, I'm going to get a higher return. So, the stocks return on average around 7% after inflation and taxes. But because I'm in riskier stocks, the small cap stocks, I might get, depending on the situation, I might get 10%. Another reason why I'm in small caps is uh, interest rates favor tech stocks. So if interest rates are low, tech stocks do well because of the way that the Wall Street discounts stocks. So Wall Street discounts stocks based on their duration, like using a discounted cash flow model. If you take more finance classes, you'll learn about that. And what happens is if you have a stock with no earnings that is a high growth stock, uh, a growth stock or a tech stock like a biotech play, a company like Google or Amazon, or even a more speculative company like Snapchat or maybe Facebook. These companies are, they're valued on really high earnings multiples because people think that the companies are going to grow a lot, especially a company like a Snapchat or a any one SNOW, Snow, any one of the software plays out there, the smaller ones. People think they're going to grow a lot, so they value them at a big multiple of their sales and earnings. And so that means they don't have earnings yet. So that means if you invested in the company with the expectation of getting a dividend or getting some cash back, you'd have to wait a long time. But if you invest in a company like Exxon, it already pays a dividend. AT&T already pays like a 6% dividend. So dividend stocks, value stocks, small cap stocks, they small cap stocks tend to be more value type stocks, although you can have small cap growth stocks. The TSPS fund is somewhat heavy on value stocks. So the reason I'm in it is because interest rates have been rising, and when interest rates rise, statistically, small cap stocks and value stocks outperform the market. When interest rates fall, statistically, large cap stocks and growth stocks outperform. So I would be in the S&P C fund, which is all large cap. if I thought interest rates were going to fall. But because interest rates have been rising lately, I'm in the S. So if the S fund performs well over the next few years, and I think the Fed's going to start cutting interest rates, then I'll move everything into the C. So I kind of allocate my money based upon interest rates. Now that's an investment strategy. My investment strategy is I look at where interest rates are, I look at the trends in interest rates and what the Federal Reserve is saying they're going to do with interest rates, and I kind of manage my stock portfolio and what I think interest rates are going to do. So that's my strategy. GARP is a strategy, growth at a reasonable price. Value investing is a strategy, growth is a strategy. I'm not a value or growth investor. I'm just kind of, basically basing a lot of what I do on interest rates. So you need to pick an investment strategy. It doesn't have to be as complicated as what I do. It can just be, look, I'm going to pick my own stocks and invest in them, or I'm going to buy mutual funds and let somebody else manage it, or I'm going to buy index funds and just let a statistician kind of sample. And index funds have beat most discretionary stock picking over the past 100 years. So they do very well. I keep a lot of my personal money in index funds as well because I think they're good investments. So, but I do invest in my own stocks as well. So I do a mix of everything. Um, bonds are considered to be less risky than stocks, right? For the most part, you can invest in junk bonds and high yield things, but for the most part, investment grade corporate bonds and treasury bonds are less risky than stocks. They also offer very low returns. So if you invest in bonds your whole life, if you invest $1 million in bonds today, 30 years from now, it's going to be worth, if you're lucky, 2 or 3 million. If you invest $1 million in stocks today, in 30 years, it could be worth 10 or 20 million. So you have to, the standard advice is you should have a blend of 40% bonds, 60% stocks, or 60% bonds and 40% stocks, some type of mixture. I don't follow that advice because I prefer the growth associated with stocks. And I'm also a federal employee and I'll get a pension when I retire. So that I feel like that pension replaces the bond component. I don't really need the bond income because I've got a pension, right? And the same is true if you're in the military, you get a military pension, that kind of replaces some of your need for income, right? So not that you should take too much risk, but you can kind of look at your pension as something that would offset some of the volatility of the stock market. So you want to complete a three-section, including insurance and investing and your current situation, 3 to 4 page paper, including a title page. So it's really a 2 or 3 page paper when you take out the title page. No in-text citations or references are required for this because you've already learned a lot in your case 4, so this is just kind of extending on that research. When you've completed the assignment, upload it to the Module 4 Dropbox. Yeah, and when we talk about investing strategies, buy and hold, if you're putting 5% of your pay in the thrift savings plan, the government will match it 5%. So it'll be like 10% of your pay. You can put it in a life cycle fund, which is a blend of bonds and stocks. You can put it all in bonds, all in stocks. There's now a TSP window, which lets you invest in other funds, structured products, things like that. Leveraged index funds, which are very risky, but they can amp up your returns if you think you know what you're doing. um, and you can invest in an IRA, which I recommend, a Roth IRA, a traditional IRA. You're allowed, if you're under age 50, to contribute up to $6,000 a year to a Roth IRA or traditional IRA. If you're over a certain income threshold and you have a retirement plan at work, you don't get a tax deduction for contributing to a traditional IRA or a Roth, but the earnings are tax free. The Roth earnings are tax free when you withdraw them. So you don't get a deduction when you put in, you get you have a tax free income when you retire. The traditional IRA deductions are taxable when you withdraw. And you have to be 59 and a half or older to take money out of either account. Now, if your income is below a certain threshold and you don't have or you don't have a retirement plan at work, you can write off your contributions to a traditional IRA. So they are tax deductible if you're under a certain income level. So that's how traditional and Roth IRAs work. I recommend both. You can buy stocks in those. You can buy mutual funds through Vanguard or Fidelity. Vanguard mutual funds are extremely low cost, but Fidelity's great, Legg Mason's great, Franklin Templeton, a lot of other places have great mutual funds. If you're interested in option trading, you can trade options in an IRA. Some places you can even trade futures in an IRA. So I do quite a bit of option trading in my IRAs, and they've done well. It's worked out. The key is if you're buying options, just don't buy too many, right? So I never buy more than 1% of my account in an option trade, and I never have more than like 10 or 15 trades on at a time. So at most I have 10% of my account. And most of the options I bought in my IRAs have been like 2-year options. So I don't buy, options that expire tomorrow in my IRA because those are even riskier than long dated options. So just some ideas about investment strategies. You don't have to get into options or anything. You can talk about IRAs, you can talk about index investing, you can talk about stock picking. You don't have to get into really advanced finance. You can if you want to, but you can just kind of talk about what your plan is. Some people, you can invest real estate in an IRA, in a self-directed IRA. You can also invest in real estate as a retirement strategy, right? Just outright. So you can live off the rental income. So if you want to, you can talk about that and how you would do that as a retirement plan. All right, so that's the SLP 4 assignment. Thank you very much, and good luck.